Forex Focus brought to you by IG, talking about the not only potential for a stock market crash, where the stock market currently lies, and what a crash might look like, but also, potential hedges for that stock crash if you are worried about it, or even if you're just of the mind of, I've got so much exposure to the stock market with my, 401k or with my passive investments. I've been stock picking and obviously, the S&P and NASDAQ and a bunch of single stocks, especially the big market cap tech single stocks, getting either to or close to those all-time highs and thinking, well, maybe I need to kind of offset some risk here. And US dollar, the last handful of years, as we'll get into, has been a decent hedge for downside in the stock market. But first, the S&P 500 is now only a 5% rally away from all-time highs. You might remember that this very popular index that has obviously the futures and ETF and so many different ways to invest, either directly or indirectly, got up to right there close to 4,800 before backing off all the way to below 3,800. So it gave up more than 1,000 points there. And now back close to right now trading around 4,550. So about 5% away from those highs that we witnessed at the end of 21, start of 22 there. And you could see through 22, obviously a lot of downside in less than a year that followed those highs near 4,800. The market lost actually 25%, more than that, 25.5% down to its lows at the end of 22. And so this is obviously something that you price in to long-term investment. There's, with very rare occurrence, any investment that you could have for years, if not decades, that doesn't see any kind of pullback at any point. It just grinds higher. And so, you, like I say, kind of price this in. Oh, I'm going to be long stocks for, I'm 30 years old. I'm going to be long for 30, 40, 50 years, or even, I'm 50, 60, 70 years old. I'm going to still have investment for at least 5, 10, 20 years, whatever it is, before you access that capital there. But of course, the next step past being passive would be to be slightly active and maybe when the market is moving through those all-time highs, you could, of course, take some investment off the table, or you can look at potential hedges. And one market that would have been a pretty successful hedge, both in the pandemic crash that we saw in early 2020, but also during the downside, the bearishness we saw in 2022, would have been this US dollar. As you can see there in red, the dollar index moving from the mid 20s all the way up and beyond 30 for the first time in years, as we saw a pretty historic dollar rise. Because not only did the dollar rise as stocks fell in both these periods, but more significantly during the downside the stock market saw in 2022, but it saw some pretty historic extremes. Dollar yen got to 30-year extremes. Dollar versus the euro got to 20-year extremes, similar for the dollar versus the pound and the Australian dollar, which is to say just US dollar at large saw appreciation during that period to, multi-year extremes there. As you see here, the dollar versus that yen got up and beyond 150 in 2022, and actually also in this year as well. And that 150 level has only been rarely seen since the early 90s, as the dollar saw, like I say, historic appreciation. Now, here is the correlation between the S&P 500 and the US dollar over the course of the last decade. And you can see that the relationship definitely changes. Throughout the mid 2010s up until, the the start of the pandemic, really, you saw both sides of it, positive correlations, negative correlations. But prior to that period and since that pandemic, you've seen some substantial inverse correlation or negative correlation, inverse relationship between the stock market and the U.S. dollar. As you've seen, it's been pretty much starkly red since that pandemic to varying degrees, negative correlation of 0.25, sometimes negative correlation more than 0.5. But that is to say that in recent years, the relationship has been stocks down, dollar up, stocks up, dollar down. And so, what you would look for in a potential hedge here, obviously, you're not looking for something that goes down when stocks go down and up when stocks go up. If you are looking for this dollar hedge against the stock market, here, there are many different ways to gain that exposure in the Forex market with varying degrees of margin requirements and costs. But some of the most popular ones here, which, as you might expect, are the bigger name pairs like your euro, your Canadian dollar, your Australian dollar, Swiss franc, Japanese yen, and British pound, have some of the lowest margin requirements. And that's for a number of reasons, some of which being they're less volatile than a minor pair, a currency that's less known, like the Turkish lira or something like that. And they usually have more liquidity than those lesser known pairs as well. So probably a good place to start when looking to hedge a stock portfolio with long dollar exposure. But just keep in mind that when you have, for example, the euro versus the dollar, which is only a 2% margin requirement, it's considered one of the most liquid markets, and can have at IG one of the smallest spreads at spreads as low as 0.8 pips there. You do have to short that euro versus the dollar to gain that long dollar exposure there, as things are a little bit different than obviously, buying this stock to diversify. I'm going to also buy this other stock to gain that long dollar exposure. You would short that euro versus the dollar. And you can see here, not only is it a lower margin requirement, but also if you were looking for a long dollar hedge, the market has moved significantly off of its lows, or the dollar has moved off of its highs into more normal territory. So you're not necessarily buying the dollar at its historical highs, as euro got all the way down below parity at the height of the stock market fear that we saw at the end of 22. As you could see, that correlation playing out right there. The lows that we saw in the S&P in October, November of 22 correlating with lows here in the euro dollar, high for the dollar in this pair, as the dollar got back to and through parity with the euro. You'd actually get more euros for a dollar than you would since, I believe it was the early 2000s. And so have come back to trade now closer to 110. But also keep in mind that, when you are hedging, when you are trying to manage risk on something like a stock portfolio, these relationships aren't guaranteed. Of course, you could have some particular circumstance whereby the stock market moves lower and also the US dollar is moving lower as well. It's not it's not guaranteed that it emits this fear gauge mentality that it has had in recent years, where it goes up as stocks go down. It's not guaranteed. Markets can change any given day. But also, if the stock market does move higher and your portfolio moves higher, you could lose considerable money on that hedge. So make sure that you're not a thing to always make sure of, and especially, teach the new risk manager, the new hedger out there, is you don't want to hedge more than the investment that you're actually looking to manage risk on, obviously. And so make sure that you get the right sizing right as well. But there you have it. If you're worried about the stock market crash, maybe that US dollar could help you out.